Good evening, everyone, and Happy New Year. 2025 is here. My name is Kevin Grolig. I don't know if you've seen me on my YouTube channel or not, or maybe you're just somebody I know, or you just happen to come across our live stream. But tonight is my first live stream ever. So have to tell you, I'm a little bit nervous in doing this, hoping that I know that we're going to provide some good content, but a little bit nervous about some of the technical stuff going on and everything. But tonight, we want to discuss what's on a lot of people's minds who are thinking about real estate in 2025. Heck, even people that may be even thinking 2026 even, because I think this is going to be a pivotal year. And we're going to discuss and kind of bat around with a local professional here our predictions for what we see happening with interest rates in 2025. It's been a crazy roller coaster over the last few months. You've heard about Fed cuts recently, and there's talk about more Fed cuts to come in 2025. But what effect is that going to have on mortgage interest rates? And so in doing so, we're going to be bringing in actually my go-to mortgage lender, Brian Morley with Fulton Mortgage. And here we have him, Brian Morley. How are you?
Kev, how are you? Good. How are you?
I'm doing well. Happy New Year.
Yeah, Happy New Year.
Thank you. So, today we're going to kind of beat around, predictions, what we're going to see in the mortgage market this year. Obviously, that's going to have a huge effect on the housing market and what we see going into 2025. So, but before we get started and everything, before we discuss mortgage rates, what type of, do you have any New Year's resolutions, any big plans I should know about? Because you are my go-to mortgage lender. So I
could make the New Year's resolution of eating healthier and working out more, but you and I both know that would probably last about 6 weeks and not really into the spring. So actually trying something a little different this year. My goal is to leave work without a to-do list every day.
Holy cow. So, I guess that leads to the question is, do you ever see yourself leaving work?
No. And because you can work anywhere with a cell phone, it's just continuing. So, but no, I'm trying to just get a little more organized at work so that I can start knocking things out and helping more people buy houses.
Yeah. And I would also imagine you got 2 younger kids, so being a little bit more present when you're with the family, I would imagine.
Oh yeah, I have a 11 and a 9-year-old, and I think if this mortgage thing doesn't work out, I have a future in Uber, because soccer, basketball, baseball, pizza party, I know how to drive everywhere. So,
well, you might want to get, flip side onto the other side of the fence and get into real estate, because I know a lot of realtors feel like Uber drivers.
Exactly right. Although you might be having better conversations with the clients than I am with the 11 and 9-year-old.
I hear you. I don't know. I think, what I found, especially, it was kind of going this way anyway, but what I found is really once the pandemic started, my job, and I imagine yours is probably somewhat similar, it kind of is morphed into more psychotherapist, family counselor than it is actually real estate agent these days, because, everybody's dealing with a lot. And of course, moving is one of those, I think the top 3 things they say in this world that causes the most amount of stress. I think it's death, divorce, and moving and taxes or so. So, I definitely feel like I could potentially go into the whole therapy role, because it seems like that's a big part of my job these days. You probably see the same.
Yeah, and it's the same thing. And I like to tell people, like, home buying is such an important process. And for many people, it's the biggest purchase that they make in their lives.
Right.
But I tell people, I'm the numbers and cents guy, and your realtor is more of the emotional guy. You can see your family growing up in this room and stuff like that. But it seems to blend over to me sometimes. And I thought maybe one time I'd put a couch in the office so people could come in, put their feet up, and tell me all their life stories. But instead, I put a putting green in so I could practice my golf.
Well, yeah. So, and has that helped your golf game at all?
No, not at all. 11-year-old, 9-year-old, and a full-time job. I don't get to play enough golf.
Yeah, yeah. So, why don't we kind of jump into today's topic, which, the big question out there. I mean, it's been a big question, probably since 2022, when we start all of a sudden saw the interest rates go from the lowest in history to the highest that they'd been in 20 years, all within maybe a 6 to 9 month span. I mean, 2022 is absolutely crazy. And, ever since then, I know you hear it and I hear it all the time is, when are mortgage rates going to start coming down? When are they going to be at 3% again? Laugh, laugh, ha, ha. But, let's talk a little bit about that. Like, what are your predictions? Have you been, do you have any articles, or have you been kind of, what are you seeing out there? Because you follow that closer than I do.
Yeah, it's a great topic, and it's probably the number one question I have. And you want to bring up an article that we were kicking around before. This is an article I found. It's from NerdWallet. It has two forecasts. There's a lot of people that forecast what interest rates are going to be, but the two main ones, and the two that the mortgage industry probably have the most backing behind it, are Fannie Mae and the Mortgage Bankers Association. And I don't necessarily always focus on the number, what the interest rate is, but what is the trend. And right. They're actually already off because rates went up between the holidays. So rates are unfortunately touching about 7% these days. But you can see a gradual trend down throughout the year. And most places show quarterly forecasts and stuff like that, but most forecasts are seeing that gradual trend down in interest rates. But it is such an interesting environment right now. And, I'd love to, if it's okay with you, Kevin, kind of, I don't know if it's a good analogy, but like there's the movie with Arnold Schwarzenegger, Kindergarten Cop, where he says, who is your dad and what does he do? Well, I want to tell you about mortgages and where did they come from. So, mortgages generally are tied to, mortgage bonds, and mortgage bonds are a traded commodity, and, everything affects that, whether it's the Federal Reserve, whether, I'll hit all the buzzwords we hear in the evening news, the Federal Reserve, inflation, unemployment, employment. So those are the main drivers of what interest rates are doing. And those economic indicators are really what analysts are using to predict which way rates are going.
Yeah. So, right now, like I say, we've seen it, kind of bouncing around. I remember, last September, maybe it was August or September, I had multiple clients that I was working with who were looking to purchase homes, who were telling me, well, we got to wait until September 18th, because that was a date where the Fed was going to be meeting to discuss interest rate cuts. And so, I had clients who literally were actually seeing properties they liked, but were kind of skittish about moving forward with putting an offer because they're like, oh, well, the rates are going to come down, on September 18th, or there's going to be a Fed cut or what have you. Well, why don't you explain kind of what happened there? Because that actually, the Fed did cut the prime lending rate, but what effect did that have on the mortgage rates?
Yeah, so the Federal Reserve sets short-term interest rate, what banks pay an interest rate, sometimes called the Fed funds rate. And it's important to realize that the Fed has a dual mandate. Their job is not to make sure that you and I get to sell houses or our clients get the lowest interest rates. They have two jobs. They want to try to maintain an inflation rate of 2%, and they want to maintain what they call maximum employment. Or I think it's sometimes called employment stability. So those are their two jobs. So when they came out in September 18th and said, we're cutting rates, I think that was the first time in 3 years, if I remember, that they dropped rates.
Yeah, it was like 2 or 3 years.
I got calls the next day, rates are going down, rates are going down. And the Fed is very forward looking. So the mortgage market responds to what will the Federal Reserve say. So the chairman of the Federal Reserve, every time there's an action, right now it's Chairman Jerome Powell, a local Montgomery County guy, actually, Kevin.
I did not know that.
If I remember correctly. Yeah, so he gives a press conference with some prepared remarks and then answers questions.
I've got a fact checker here that's going to check into that. So we'll get back to you on the fact check on that one.
Please do. I think I'm correct. But what the Fed has done is they kind of, created this excitement by dropping rates by 50 basis points, but then they kind of poured water on their flames and said, well, we're still going to be data dependent. Our goal still remains to bring inflation down to 2%. And also we have to worry about, employment. And basically what that told the market is, well, we're not going to drop rates as fast as you guys thought or as quickly as you guys thought. So there's not always a correlation between what the Fed does and what mortgage rates do.
Right. And so explain to people, what affects, the actual mortgage rates more, what directly affects that? What are some of the signs that people should be looking for, or some of the markets that they should be following to kind of get a better sense as to, where mortgage rates might be going?
Yeah. So three things. First of all, unless you want to spend $20,000 and buy a Bloomberg terminal for your house to track mortgage-backed securities, the best thing to look at is the 10-year Treasury. So the U.S. 10-year Treasury is a bond, and you can follow it. And for the most part, mortgage pricing tracks with that 10-year Treasury. So that's a good place to look. The two things outside of any geopolitical events, wars, COVID, any oil crises, the two biggest things that affect mortgage rates are employment and jobs data and inflation. And they're inversely related. So as unemployment goes up, generally, it's showing that the job market is weakening. That means that normally mortgage rates are going to come down. And as inflation comes down, normally rates will follow course. So again, that's a high level overview. There's a lot of, if people are fact checking me, there's probably examples where that didn't happen or reasons why they wouldn't. But right now, those are going to be the main drivers of bringing mortgage rates up or down. We want to see, we're not rooting for anything bad in the economy at all, but for mortgage rates to come down, employment needs to soften and inflation needs to come down.
Right. So, I kind of was preparing for this live stream. I was looking up, what some of the predictions were for like National Association of Realtors. I know that Lawrence Yun is our chief economist at NAR. He was predicting that rates would probably, I'll be honest with you, what I'm mostly hearing, and tell me if you're kind of feeling the same thing, is that it's kind of going to be a lot of the same. It's up a little, down a little bit, but I don't know that anyone's predicting that we're going to see interest rates really drop for any extended period of time below 6% or so. But it doesn't seem like there's also anything on the horizon that's going to show them going up either. It seems like we're kind of stuck right now, and at least for the foreseeable future, in that 6 to 7% range. I mean, is that kind of what you're seeing right now?
Yeah, and if you look at all of the experts with their predictions for the year, they're all in that range. They're all in the same thing. What a lot of people have talked about is we might see some fluctuations. So through the year, you might be closer to 6 or closer to 7. The challenge is, the Fed is sticking to their mandate, whether or not, you get into a whole political argument whether or not they should or shouldn't, but those two pieces, inflation at 2% and maximum employment, them sticking to them has kept rates in this same spot. And you mentioned earlier, I get that question, when rates come back to 3%, I think I'm going to be pushing Kevin around in a wheelchair when rates get back to 3%, because it's going to take a global pandemic for us to see 3% again. Something has to go really wrong for that to happen.
And so, and look, the last thing I want to do, obviously I'm in real estate sales, you're a mortgage banker. So the last thing I want to do is come across as overly salesy or anything, but kind of what I'm seeing on the horizon for 2025 is a lot more of the same. I don't think there's going to be any real huge jumps up, jumps down, or spikes up, jumps down, or anything like that. And so if you're kind of sitting around waiting, you probably need to, get off the fence and do one thing or another. Either you're going to just stick it out and wait forever or for quite some time. It's probably going to be more than a year or so, or just get out in the waters and this is kind of what you get. I mean, that's kind of the way I see it. Like, I think a lot of people have been waiting now for 3 years and, I just, from what I'm seeing right there and what I'm hearing from you and kind of what I'm reading into it is, don't expect any huge jumps, for tomorrow or any huge drops for interest rates this year. So if you're thinking about doing something and you can qualify, it's probably about as good as it gets right now. But don't expect to see it at 5% tomorrow or, by April or May or something.
Yeah, I couldn't agree more. When rates came up in 2021, 2022, some people then stepped out of the home buying process, waiting for them to come back, and they've only gone up since. If interest rate is your only reason to wait to buy a house, in my opinion, that's not a good reason to wait. There are plenty of life reasons not to buy, but waiting for a lower rate, it's not really. There's no, to your point, Kevin, there's no solution that's on the horizon at this point.
Yeah. It's funny because I don't have anything to put up on the screen, so I'm going to kind of look down and read this. But, once again, when I was kind of looking at Lawrence Yun, who, once again, he's the chief economist for National Association of Realtors, his prediction, one of the things that really jumped out to me was he said, Yun explained that household equity in real estate is at a record high. This means there's been a huge increase in wealth for realtors' past clients, not realtors, but their past clients, to the tune of $35 trillion. Yoon highlighted the glaring difference in estimated median net worth between homeowners, which is at $415,000. That's their average net or median net worth for homeowners, and renters at $10,000 in 2024. And he just said that homeowners' wealth steadily rises while renters' wealth does not. So if you do not enter the housing market, you're in the renter class where wealth is not being accumulated. If you want to participate in the housing market, the sooner you get in, the sooner you accumulate wealth. And once again, as a salesperson, that can come across sounding very salesy, but, I so see it. And, once again, I think that my feeling is, kind of knowing we're in more or less a stagnant interest rate environment, once again, if you can qualify, if you're thinking about buying a home and you can qualify and you can, with a mortgage lender, and not just qualify, but also, you can purchase a home that suits your needs and still fit it within your budget, albeit, everybody's feeling the squeeze more so today than they were, in 2021 and 2020. I still think that, I still think that it makes sense to do that and really, because the values of the homes, while they're not skyrocketing right now, at least in our area in the DMV, now that may not be everywhere. I realize that there's pockets of the country where values are actually starting to decline, like a lot of the Sunbelt states and things like that. But, in our area in the DMV and in a lot of other parts of the country, we're still seeing values rising. They may not be going up 10 or 15% a year, but 3 to 5%. That's a heck of a lot when you're talking about, the median sales price being, maybe $600,000. What starts at $600,000 this year, even if it only goes up 3%, that's close to 620 by the end of the year or so. And so, I think that really kind of rings true that, if you're thinking about it and you can do it and you can qualify and fit it within your budget, it makes sense to do something probably sooner rather than later. Because I think that the divide is just, increasing, and those statistics are quite sobering to hear that the median homeowner's net worth is $400-something thousand and the median renter is $10,000. I mean, there's a huge divide there.
Well, it's interesting. As I was preparing as well, I read not his article, but a different article, and it had almost identical numbers. And what I always encourage people to do, people think that there are a lot of barriers to homeownership, to purchasing a home, and financing is normally what people see as the biggest barrier. What I always encourage people to do is have a conversation. Let's understand it. Let's make sure that you're fully educated. You understand what the math looks like. Because unfortunately, there's a lot of misconceptions that people have. Did you know that the more than, I forget the stat, I'm going to put my foot in my mouth here, but I think it's more than 20% of people still think that you have to put 20% down to buy a home.
Yeah.
And some people do, some people don't. There's options for both. And, there are a lot of benefits to homeownership that a lot of times first-time home buyers don't have a full understanding of. So if anything, I think it's worthy of a conversation.
Yeah. So I'm actually reading some of the comments that have come in, and a few people have said, "Hey, good stuff. Hey, I appreciate that." Like I say, I'm a little nervous. Admittedly, Brian knows this because he saw this off camera, but I did take a shot of Fireball before I went on just to kind of loosen up a little bit because I was tight. But anyways, got a few good, nice comments there. So thank you very much for kind of tuning in and your positivity. Eli Maggods said that he saw a Wharton professor say best case for rates this year is 5.5 to 6%.
Yeah, I think that's, one of the experts that I looked at, he was calling for, high fives as well. He was, the way we get to those rates are unemployment goes up and inflation goes down. If unemployment goes up and inflation goes down more than expected, we get there. Now I'm going to get super nerdy on you and stuff like that. The Federal Reserve had voting members, and every time they have a meeting, they make an announcement whether they're adjusting rates or not. But what they also do is they put out a dot plot, literally dots plotted, and it's indicating where they think that the Federal Reserve interest rate is going to be. Short-term rates, not mortgage rates. And they think most of them expect a 50 basis point reduction next year. So this year, 2025. That's the first time I've done that this year, confused it with last year. So that means there's only 2 cuts in the majority of the voting members of the Federal Reserve mind. What does that mean? That means that they don't see unemployment going up or inflation going down as quickly as others do. So if they're wrong and unemployment goes up and inflation goes down, the Fed will act a little quicker, and likely that will improve mortgage rates as well.
So, this, I'll take it. Yeah.
I use this too for a lot of predictions, the old magic 8-ball, which is probably better than all of these analysts I've read.
Yeah. So, okay. So, I'm going to have a question for the magic 8-ball.
Okay. Hit me.
Will the interest rates be in the 5% range by the end of the year?
Oh, wow. We got a good one. It is decidedly so.
Boom, everybody. We can end this right now.
We're done.
It's done. Hey, everybody. Thank you for it. But nice. I appreciate you bringing the magic 8-ball. And just a little side note, I actually ordered one from Amazon myself because I planned on having one. And the damn thing didn't show up today. Probably because all the snow we've had here recently and everything, but whatever. So I'm glad you had the magic 8-ball.
It was not decidedly so that you're going to get your 8-ball today.
Yes, exactly. So we got a few other questions here, which I'm going to. Bart Ransoni, which actually I have a neighbor named Bart. But I don't think this is the same person because his last name is Ranson and this guy is Ransoni. So he asks, how is the interest rates impacting the market? Buyer versus seller. Also, if I'm looking to purchase a bigger house, do I need to sell my house first or buy or buy, then sell? So I guess he's kind of asking, like, in what order would you do that if you had a home if you currently own a home and then you were looking to purchase another one? So let's kind of take that piece by piece. So, Brian, why don't you answer how is the interest rates impacting the market, for home buyers?
I think home buyers have come to an understanding that rates are where they are. Probably since the middle to end of 2023, so 15 months or so, they've been pretty consistent, probably 50 basis points up or down, 0.5%. And the homeowner has kind of left the idea of 3% mortgage rates. It's gone. They've accepted it. So I would say that interest rates maybe in 2022 might have slowed the market a little bit. I don't think rates are slowing the market at all. I think buyers.
Well, it does. Obviously, it does affect affordability. Every time the interest rates go up, somebody gets knocked out of the housing market, or at least their ability to purchase, is lessened. So, so it's definitely hurt that. But, you're based out of Howard County or so. So you're kind of in that greater DMV, Baltimore area and everything. But how are you seeing it affecting most of your clients?
I think that it's not affecting them as much as I would have expected. I think they have a good understanding of where rates are. They're being educated up front. What I think it has done, and Kevin, you're probably better to speak to this than I have. If you go back to 2020, 2021, when rates were the lowest we've seen, low rates led to wild price increases and escalations, and people would more or less do whatever they want to try to buy a house. And I think the rates where they are have had more of a measured approach to home buying.
Right. Yeah, I would agree with that. What I see from the real estate side of things is I think the people that have been hurt the most has really been your first time home buyers, especially. Because, typically they're working with tighter margins to begin with. Oftentimes that's lesser income, that's lesser down payment and everything. And, speaking, for Montgomery County, Maryland, last year in 2024, pretty much 1 in 4 homes that sold. Actually, let me take that back. It was really more like 1 in 5. It was about 20 to 21% of all home sales in Montgomery County last year were cash offers. And a lot of those cash offers came in those lower price ranges. A lot of times they were investors going in there buying your starter townhomes, your starter single family homes, condos, things like that, where naturally there would be a lot of first time home buyers. So, I've definitely seen some first time home buyers who have, I'm not going to say I haven't really had any that have been kicked out of the market because of the rates, but just simply because of the climate of the market with so many cash buyers in there, especially, once again, in the lower price ranges that, in Montgomery County, that would sadly be $500,000 and under for the most part.
Yeah. And I think you've seen the same phenomenon in most markets, just numbers are a little different. We do a lot of lending. We do a lot of lending in Baltimore City. There's a lot of great programs for first-time home buyers in Baltimore City to help support home ownership. And same thing, you're getting beat out by investors and cash offers that aren't allowing people to leverage the financing that's available to them.
Yeah. So going back to Bart's question, so I'm going to kind of handle the second part, because he said, how does the interest rates impact, the buyers? Well, we discussed that versus the sellers. And really, what I've seen is, everybody has seen this. Everybody's been bitching about low inventory for actually pre-pandemic. That goes back before the pandemic, but the pandemic just made it even that much worse. But, and part of the reason we have such low inventory now, even though it's creeping up some, a lot of it is because of the interest rates going up. I have so many of my clients who have purchased, in the last 10 years. Heck, even if they purchased 10 years ago at a higher interest rate, of course they refinanced, in the 2020s, 2021s. So I'm not exactly sure what the numbers are today, but I venture to say that probably 70% of homeowners that have a mortgage across the United States have something 4% or lower right now. I think I'm pretty close on those numbers. Yeah, and really what it's caused is basically like rate freeze. I mean, or a housing freeze, where I have so many clients who are like, Kevin, we really want to be closer into work. I really would prefer to get my kids into this school district. We need a larger home. We need a smaller home. But as much as they like the idea of making a move, and they like the idea of getting closer to work or getting in a school district, they freaking love their 2.75% interest rate that they have. And there's just too much of a gap between 2.75 to 6.5 or 7% where we are today to make that move. However, what I'm starting to see, and of course, we're 1 week into this year, but what I'm really starting to see is I'm getting a lot of calls right now from home sellers who've been just like home buyers who've been putting it off, who finally are like, dude, I can't put it off any longer. Like, we freaking need to get out of this house now. And they're starting to bite the bullet, which I think is going to be good for the housing market, because it's going to create more inventory. Because I've got a lot of properties that are going to start hitting the market here over the next few weeks. And a lot of them are clients who've been wanted to move a year or two earlier, but they just, now they're just kind of biting the bullet. So the interest rates, no doubt if the interest rates came down, and I always say, and our CEO at Compass, Robert Refkin, says the same thing. He believes that if interest rates were, not that I think this is actually going to happen anytime too terribly soon, but if they got down in the fives, 5 point whatever, it could be 999 for, just a 3 months, 4 months, that will open up things a lot right now. But it's like, we've flirted with getting down below 6 a few times, but then it's like you sneeze or you blink your eyes, and 2 days later it's back up to 6.5 again. And, but so there's definitely a lot of people out there who want to sell. But I think they've kind of gotten frozen to the house with the low interest rates. But I'm starting to see that iceberg starting to kind of break up a little bit. So that would be my feeling as far as, what impact the interest rates have on home sellers. I will tell you, most of the homes that I had last year, last year was kind of like a tale of 2 different years. And frankly, it's not just last year, it's really every year, with the exception of the two real pandemic years, 2020 and 2021, where it seemed like there was absolutely no seasonality to the market whatsoever. It was just balls to the walls for, felt like 2 years straight. But, since 2022, 2023, we're starting to see more seasonal markets again in this area. And what we're really seeing is strong Q1, strong Q2, and then flattening out Q3, and definitely falling down some in Q4. So, I think that what I'm finding right now is those first 2 quarters of the year seem to be the best times of the year to sell a property, because the buyers are out there. And, I'm already starting to kind of get those calls from buyers right now who are ready to come on out and play. So, so Bart, Bart asked another question. I'm looking to purchase a bigger house. Do I need to sell my house first or buy? And I'm going to tackle that with you, Brian. So what I would say is, first of all, find out what your options are. So, some of my clients, they don't have the ability to purchase a home without selling their current home. They need the equity out of their current home. Now, there's ways that we can potentially get equity out. There's bridge loans, things like that. You might want to touch on that. But, really and truly, there's people that, they need the equity from their home, or they need to have that mortgage paid off in order for them to qualify for the new loan. So I would say, Bart, that the first step is to, talk to a realtor first, a professional realtor in your area, preferably one that lives close by, knows your neighborhood well. And, meet with the real estate agent first, get a real good idea of what the value of your property is, not just what Zillow says or what Redfin says or what, Uncle Earl says or whatever, but, get a really good idea on the value of your home. That's a good, reliable value. And then the second step is to talk to somebody like Brian to find out, like, are you able to purchase a home? Are there ways to be able to purchase a home first and then close on it and then sell your home second? So what are your thoughts on that, Brian?
Yeah, no, I think you outlined it pretty well. It's about a team approach, right? So the buying a house while owning a house I think you have to engage your team. You have to engage your realtor as well as your loan officer so that everyone's working in concert to understand how to get you to your ultimate end into this new house.
Right.
If you have equity in your current home, the question that Kevin hit on is, do you need to have that equity in hand to buy the next house? Or is there kind of a stopgap where you can leverage other means to purchase the new house before you sell the old house? And, Kevin's better suited to answer this, but very often you could be in a better financial position if you're able to make an offer to purchase a home without the contingency of selling your home. And then when you go to sell your home, if you can let Kevin and his team stage it, do whatever they need to do to sell it for the best value they can, it might put you in a better position. Plus, you might only have to move once, and I don't like moving, so why pack twice?
Yeah, I mean, once again, I've had clients who can afford to it's interesting, and you see the same thing, Brian. I mean, you have people that probably come to you and they want to push the outer limit, get me the biggest mortgage I can because I want to buy the, and you're kind of having to hold them back. Like, look, man, we can only go but so high, and even then, I wouldn't suggest it. You need to come back. I mean, I'm sure you've had those type of people. I've had them too. And then, of course, you have the opposite extreme where they're extremely uber conservative and everything. And that's one of those things. There's really no rights or wrongs. It's just, it's what works for that person. But, I've had clients who have the ability to be able to, purchase a home first without selling their home. But they're like, you know what, that's just too risky for me. Like, I don't really want to get stuck with two homes. And, I completely get it, the other side of it is, okay, well, we don't need to do it that way. We could potentially sell your home first. Okay. But now you're kind of in a tough position where you're going to be probably under some pressure to be able to go out and find something super quick. And, and the last thing, I always tell people, it's like, look, man, the last freaking thing I want to do is leave you homeless. Like, I don't want to just sell your house and not find you anything because, I've already got, another family I left homeless living in my basement now. So I got no more room for you guys,
Mm-hmm.
And so just to add a little bit of levity to it. But, unless you're just infinitely rich and you can buy everything cash and you have no mortgage on your current home, I mean, and you can do whatever you want to do. For most people, it's a tough call. But to finish up on Bart's question, I think it really all starts with, are you even able to purchase something, before the sale? If you're not able to do it, well, then, that just takes that off the table. And now we have to kind of deal with, selling your home. Maybe you're going to need to make an alternative move. Maybe we need to negotiate something like a rent back, for a few months to stay in your existing home while you're looking for another one. So anyways, we got some other questions lined up, but thank you for your question, Bart. Stacy Cheney, she says, do you expect more housing inventory available this spring than in the past couple of years? And given the time and prediction of not much movement to rates. And I think I kind of answered that. I'm starting to see it already, in Montgomery County. We entered this year with 20% more inventory than we had the year before, but it's still, immensely low. But, it's like a pond that just kind of like completely drained down to next to nothing. And you got fish flopping around, like just looking for water. And now it's starting to fill up a little bit, and so they're kind of swimming around a little bit. So yeah, I do expect that we're going to see more inventory hit in the market because once again, you've got more people, I think, who have just put off selling their home. And it's just like, dude, I need to freaking move on. I got somewhere to go. And so I'm starting to see that with some of my clients, and I'm sure I'm not the only one out there. Evidenced by the fact that we had about a 20% increase in inventory last year. I think we're going to continue to see that. So that's a good question. And thank you for asking that. We got a few more. Let's see. So Anissa says, I'm planning to sell my house in Ham Lake, Minnesota this spring. Where is Ham Lake? I'm not familiar with that in Minnesota, but unfortunately, I'm not licensed there. However, I do have a good network of agents throughout the country. So, Anissa, if that's something that you're interested in, certainly hit me up. by email or text, and we'll throw that up in a little bit. And I'd be happy to help you discuss it with you. First of all, no problem there. I'd be happy to discuss that. But I think one of the best things you could do is, if you don't have a good agent out in that area, is to find a good agent. And I can certainly, help you in doing so. So thank you for that. And let's see. Kristen Grolig says, hi, Dad. Okay. Hey, Kristen, how you doing? Thank you. Get a little support from my kids here. Anyways, okay, so we've kind of gone through that. We've kind of determined, what we believe is that interest rates are probably going to fluctuate a little bit. No, we're not talking any huge jumps or drops this year. Nobody's predicting that. So I wanted to kind of transition a little bit, Brian. And well, you know what? I got to take the 800-pound gorilla out of the room. Okay, I got to bring up the T word. What do you
Tariffs?
think? Well, two T's, Trump and tariffs. They kind of go hand in hand, So what do you see with that? Because there's a lot of talk, Trump administration coming in, you've seen, the stock market, react positively. But what do you see? How much effect does a new administration come in? And then one that's talking about tariffs and all that. So, kind of tell me a little bit about that.
Yeah, so it's definitely going to be really interesting. And if we go back to earlier, unemployment and inflation, tariffs are inflationary. Tariffs will theoretically drive the price of goods up that we have to pay for. That will create more inflation. The bond market, mortgages, didn't really did like Trump and didn't like Trump. And then it kind of got better. And one of the reasons why it got a little better is, some of the individuals he's surrounding himself with, and this is not a political rant one way or another, but his Treasury Secretary seems to be somewhat friendly to what would be helpful for bonds. Tariffs, I think, are the biggest issue that could affect rates. I actually studied political science as a college student, and then I realized that I didn't want to get into politics. Instead, I'd rather hang out with you, Kevin, and work on mortgages. But I think the biggest question is: are these negotiating tactics that President-elect Trump is trying to use to create better trade deals, or will he actually impose that? What will, to go even further, what will his influence be on the conflict between Russia and Ukraine? Because that could affect the geopolitical environment in Europe, the Middle East, etc., Asia. So all of those are the two pieces, in my opinion, amongst others that drive. A lot of presidential candidates talk a lot about mortgage pieces, whether it's Fannie and Freddie removing them from conservatorship and other things. But I don't see anything major that the Trump administration can do in the mortgage space. It's the financial sector that they'll influence that will drive rates.
Wow. Yeah. And that's, it remains to be seen. This will be an interesting ride. Would you agree with that?
Yeah.
So yeah. I've got another question. So Ashley from New York City reaches out and says, would you recommend a 30-year fixed mortgage at a higher rate or a lower adjustable rate with the plan to refinance later? Are there concerns that rates would go up even higher? That's a good question.
This is a great question, and one that we have almost on a daily basis with individuals. So for those that don't know, adjustable rates or ARMs, oftentimes have a fixed rate for a period of time, and then they begin to adjust. So, for example, let's say a 30-year fixed is at an interest rate of 7%. A 7-year ARM might be at an interest rate of 6.25. So that means you have a fixed interest rate of 6.25, And then after that 7-year period, it would adjust based on what the market is doing at that time. And those adjustments are set. The mechanisms for the adjustments are set in advance. So you know what it will be based on what the indices will be at the time. I think it's a very personal question. So a lot of things go into it. First of all, if you're going to take an adjustable rate, you have to understand it. That was one of the pieces that led to the financial crisis in 08 to 10. A lot of the products that led to that are no longer out there, but an educated consumer now goes a long way. Number two, what is your outlook for the house? For example, we offer a special program to medical professionals, doctors, dentists, pharmacists, and veterinarians. And very often a doctor will stay in residency or fellowship for a specific period of time, 3 to 5 years, depending on the particular program. So sometimes I'll talk to a doctor who he or she may be in the area for only 3 to 5 years. So an adjustable rate in their example might make a ton of sense because they might not be here. They're going to move back to Ham, Michigan, and buy Ham Lake, Michigan, and buy that house. So I think there's a lot of reasons to it. And then what a lot of people have done over the last few years is they're saying that, well, hey, I'm going to take an adjustable rate now because I think that rates are going to be the same or lower down the road. So I want to take advantage of this lower rate now, save me money, or increase my affordability with the understanding that I'm going to refinance it. So are there concerns? Yes. But as long as you understand it, work with a loan officer who explains everything properly to you so you have a good understanding of it and are prepared for it, I don't have any concern with it. Now, there are some people who will say, I only want a 30-year fix, and that's okay too. It's really a personal decision of what you and anyone you're borrowing money with, what you're comfortable with.
Yeah, I mean, a lot of people hear arms and they kind of immediately like, oh my God, I'm never going to touch one because, of course, a lot of them either had a bad experience or had a family member or friend who had a bad experience back in the whole 08, 09 crisis and everything where, let's be honest, I mean, there was a lot of predatory financing out there these days. But, with some of the adjustable rates, like you were talking about, was it a 5-year or 7-year arm you were talking about? 7,
yeah, I use 7 as an example.
Yeah, I mean, those are pretty, in my opinion, pretty harmless because heck, hell, a lot of people, the average person in the DC area holds on their home 6 or 7 years. So, a lot of people won't even be around in that house after 7 years. But even if they are, that gives you a lot of time to ride out different markets and everything. And the chances are here, we've been kind of discussing and batting around what we see with interest rates this year. And we're, in my opinion, sorry, everybody, I think it's going to be a kind of a big nothing burger. I mean, it's going to be just kind of a little bit back and forth like this. But I do see that, it's somewhere down the road. I think that there will be kind of a break where the rates do come back down some again, where it would make sense if you're able to, to refinance or so. And that might make sense at that time.
Well, and if you think about it too, if in the DC market, Montgomery County, if people are only in their house for 6 or 7 years, people are in their mortgages for even less time because life events happen, refinance opportunities. I'd have to refresh this statistic, but I think when I looked at it a year or two ago, the average length of someone in a loan was less than 7 years.
Oh, wow.
So, yeah, the majority of people don't take it very long.
So out of curiosity, Brian, where are you licensed to do mortgage loans?
Yeah, so we're a bank, so we're licensed in all 50 states, but practically we only lend in the Mid-Atlantic. So we define that as New Jersey, Pennsylvania, Maryland, DC, Delaware, and Virginia. Okay.
But so you can or you can't lend outside of those areas?
Yeah, so I can only lend in those areas.
Okay, gotcha. So, I thought it was interesting because you and I had talked about a client that I have who's going to be purchasing later this year, and you kind of brushed upon it a minute ago about just some kind of niche loans that are out there. And you mentioned it's like a physician loan or a doctor's loan. So why don't you tell us a little bit about that? Because I found that to be, I found it to be fascinating, the what's out there for doctors and I think you said is it pharmacists too?
Yeah, so it's a medical professionals product. So it's doctors, dentists, pharmacists, and veterinarians. We offer unique financing with low down payments or no down payment in many cases, with the thought process that very often there's a high cost of education and training with the inability to earn during that time frame because, you're a medical resident working 60 to 80 hours a week. You can't go work at Chipotle or whatever, making some money on the side. So we recognize that a lot of these professionals haven't had the opportunity to save for a down payment. So we're willing to craft unique financing. For example, we'll do a loan for a doctor under certain criteria, of course, with no down payment to a sales price of 1.5 million. And again, it's in recognition that they have been in school, residency, and training, earning a modest salary without the ability to save for a down payment, with strong earning potential in their lines of work.
So they can borrow up to 1.5 million with zero down?
Zero down.
And like, what type of rates are we talking about? Are we talking about rates that are kind of just in line with?
Yeah, generally in line with what market rates are. This is what is sometimes called a portfolio product, one that, the bank that I work for, Fulton Bank, we retain on our balance sheet and we make under our guidelines. So it's not sold in the secondary market, but yeah, they're generally market rates. You're not paying more for the benefit. And there's actually some benefits to the program as well. Generally speaking, when you put less than 20% down on a mortgage, you have to pay mortgage insurance, which is a fee that you pay that protects the lender's interest in the case of default. With our medical professionals loan, even though you're putting less than 20% down, no mortgage insurance is required.
Daggone, man. That's crazy.
Yeah.
So I need to start looking up all the doctors and veterinarians I know and getting them over to you. Correct?
Yes. Yeah, we can help them.
Awesome. So we're kind of winding down. So let's talk about like first steps. So for those people that are out there, they're thinking about buying a home in 2025. What would you say their first steps should be before they just get out there? I mean, because, it's really easy these days to find homes on Zillow or Redfin or Compass or Realtor.com, wherever. But what do you think, what would you recommend the first steps be for somebody who's looking to buy a home in 2025?
Yeah, I think the first logical step to me is always a pre-qualification or pre-approval. You have to understand I always tell people two things. What do you qualify for and what are you comfortable with? So you talked about some people trying to push limits. We want to understand what type of loan is best for you and what you qualify for. And then secondarily, what are you comfortable paying every month? You talked about not leaving people homeless. I tell people all the time, even if we can put you into a loan product, you're the one that has to make the payment every month. I want to make sure you have an understanding of it, and a comfort level of it. And once you have that pre-approval and you understand it, then you have to connect with, your realtor, Kevin, so you understand, what does that get you? And you can hone your search criteria. And to me, I view this transaction as a team approach. And you need to set up your team, and your team needs to be working together for you. And your lender, your realtor have to understand what each other is doing, and you have to talk to each other about it.
Yeah. I always say that your realtor and your lender are like your left and right arm, and they've got to be working together, communicating together. And it's got to be Team Jones or Team Smith or whoever that buyer is, that everybody is basically singing from the same hymn book there. And I really appreciate you saying, because you and I, and that's part of the reason I like you. And it's part of the reason why I trust in referring my clients to you, is what you just said, which is, there's a difference between what you can be qualified for and then what you feel comfortable with. And once again, everybody's a little bit different. Some people are willing to take a little bit more risk, others not so much. And so, I always say that to my clients. I said, one of the things I like about Brian is he's a straight shooter. He's going to tell you what you can qualify for, the max that you can qualify for, but that may not be what you feel comfortable with. Ultimately, he'll let you know this is what you qualify for, and this is what your monthly payment would be if you put down X percent. But he might say you're qualified for a payment of $3,000 a month, but you only feel comfortable paying $2,500 a month. Hey, no problem. We can work with that. It just means that we're going to need to scale back a little bit on the price, or if there's a way possible, you're going to need to come up with additional cash to put down a higher down payment, which, may or may not be possible for people. But that's one of the things I really appreciate about you, is that you're not just trying to, get somebody into the highest loan possible. Just like, with me, it's like, I don't want to sell somebody a home. I want them to buy the right home for them under the right terms and everything, so that they feel comfortable in it and they're not living in regret saying, what the hell did I just do? So I definitely appreciate that with you. And any other tips, as we're kind of winding down, of things that, you can think of, somebody's starting to think about buying a house, I talk to a lot of people and they're kind of like, well, I'll suggest that they contact you. Well, we got to take care of this first, and we got to pay off that. And, I'm waiting for a bonus to come in, or, I probably, especially you get this a lot like February or January, February, March, where, I got to, file my taxes or whatever. So what would you say to somebody who's in that position, who's, wants to buy a house, but they're thinking they're not quite, they shouldn't call you yet because they're not quite ready? Is it ever really too early to call you?
No,
to reach out?
No. And I tell people all the time is something we can never make up in this process. There are a lot of misconceptions about mortgage lending. Consumers think certain things can work, or they can do it a certain way. But oftentimes, not often, but sometimes what will happen is we might need to do some credit repair, or we might have to pay off something, or we might need to consider a new strategy. And the more time that we have to do that, the better. And a pre-qualification or pre-approval with me or any other lender is non-binding. What it is simply a free consultation into what your purchasing ability is in the market. So whether you want to try to buy this weekend or in December, I always encourage people to have the conversation about a pre-approval as early in the process as possible, so that if there are any steps you can take to put yourself in a better position or get yourself a better deal, let's do them as quick as we can.
Yeah. And also, what I've seen is also you can find some surprises there too. There could be some surprises on your credit report, especially if you've got a common name, like you are a Jones or a Smith or something like that, where I've seen situations where, people have something on their credit report that may have been their kids, they have a son or a daughter or whatever, or it could have been their parent, or somebody who had the same name is just showing up, and you don't even realize that it's there. And, you have the time to kind of take care of that and repair those type of things. And also, you guys are always going to do what they call a tri-merge credit report, where you're merging the three major credit reporting bureaus together, and oftentimes there's discrepancies between what one says and another says and things like that. So you can't, even though you think your credit's 800 and you're fine and everything, sometimes shit happens, and stuff out there that you're just not even aware of.
I know we're come close to the end, but you hit on this story, and we didn't plan this story, I promise you, but I had a client. He had a very common name, and his son was the second, third, I don't remember what. But he had to co-sign his college library card because the child was under 18 when he went to college. So this guy is very well heeled, very well qualified, buying in the DC market, and he didn't want to have his credit pulled. So I was encouraging him and said, whatever. He waited till the end. Long story short, his son didn't turn in a library book 10 years ago, and there was a collection from the college on his credit report. The guy hadn't looked at his credit in so long, he didn't even know it was on there. And listen, wow. We helped him. We jumped through some hoops. We got it taken care of, and we helped the guy. But it created some heartache, and I think his adult child got yelled at for the first time in a long time. So you're absolutely right. There's things on there. There's medical collections. There's your Comcast device that you didn't turn in. There's your apartment that you forgot to turn the gas and electric off. There's things that happen, and the sooner we can look at it, the better.
Yeah, no, I 100% agree. And also, a good mortgage lender like you can strategize with somebody. I'm sure that you've worked with people who have, let's just call it blemished credit, and you can actually look at their credit and say, look, if you were to pay down this to this and you do this and do that, a lot of times it's, what I find is it's some small tweaks here and there. It's not always like, I got to pay this off. It's like, I got to get it down to this amount or so. And you can get this over here and clear up this, this little poopy thing here, like your freaking, library book or whatever. A lot of times it's not a lot of major things. It's just some tweaks and things like that, people just don't even know, it's not as hard as they think oftentimes.
Oh, couldn't agree more.
So anyways, well, listen, we're running out of time here. I want to thank everybody for all their questions. Eli wrote something in here about once we get Greenland, we'll be golden. So you wouldn't be able to do a mortgage for a purchase in Greenland, would you?
If it becomes the 51st state, maybe I'll open up a shop up there.
So anyways, but I want to thank you, Brian, for joining me on my first ever live cast. I want to thank everybody who I saw as many as like 13 or 14 people here at one time. So I want to thank everybody for joining in. By the way, I'm going to be back doing this every week. But I'm going to be doing it on Tuesdays, not Wednesdays. I actually did this just to help Brian out because what do you have, your son's baseball or something like that?
Yeah, Uber service to baseball.
So anyways, next Tuesday, 6 p.m., I'll be back, same place and everything. So I want to thank you guys for joining in. And as always, if there's anything you need when it comes to real estate, if it's in the DMV area, I'd love to help you out. Best way to get in touch with me is by text, 240-793-7495. Also, we've got the QR code that's on here right now. So if you, we'll keep that up for just a minute while I blah, blah, blah. And if you want to scan that, you can actually set up a one-on-one appointment with me via Google Meet, where we can actually discuss whatever plans you have as far as real estate. But anyways, thanks once again, everybody. And, looking forward to doing this. So thanks so much. And everybody have a great evening and Happy New Year.